Welcome, everyone. I'm very glad to see that so many people followed our invitation to talk about this topic today, which I think is very timely and relevant because it's probably fair to say that almost any high-level debate that you can currently follow in the EU somehow concludes that we need more investment in the EU, be it the debate on competitiveness with or where the Draghi report and potentially the leak of the clean industrial deal that you might have seen really name some very substantial investment numbers that we need, be it the geoeconomic tensions and how to reduce the EU's external dependencies, where we need more investment. And last but definitely not least, also the green transition, where we know that the investment gaps that we face to achieve both our 2030 climate target, where I think the annual investment gap is around 477 billion euros, and the 2050 target, where it's even higher with 620 billion euros, are very substantial. And this comes at the same time with still major fossil investments or harmful investments flowing sort of in the wrong direction, so to say. Which is why our work and our webinar today refers to both mobilizing new green investment, but also to redirecting harmful investment into green investment. And while it's pretty clear that the public sector has a critical role to play in mobilizing these investments, there are also many estimations that clearly show that the majority of these investments have to come from the private sector, which is why we at ZOE Institute, recognizing this crucial importance of private capital for this transition, have been embarking on this project, the results of which we are presenting today, which is about what can public policymakers do, what do we have available in terms of public policy tools to mobilize and redirect investments for the green transition. We've started this work by talking to many different stakeholders, so policymakers, stakeholders from the business side, but also from also experts from academia and think tank, to first of all understand what are the barriers that we are facing when it comes to mobilizing and redirecting private capital, to then be able to derive policy tools that can address these different barriers. And there are two main findings coming out of that. The first one is that it's not only about attracting capital. So it's not only about making sure that companies or other investors have the access to capital. It's also, or sort of this is a too narrow focus. We also need to look at, for example, is there even a business case for an investment? And even if there is an investment case, what about the implementation side? Is it even feasible to implement the investment, or are there real economy barriers like a lack of skilled labor, for example, that would hinder these investments? The second finding is that if we really want to be successful with that and mobilize such a huge amount of investment, we definitely need a systemic approach that does not only look at the surface level barriers, but also at the more deeper rooted barriers. And while I'm very happy to, or looking forward to present what exactly we mean by that in our work in a few minutes, I'm very glad that for now I can hand over to our excellent guest speaker, who definitely brings the right expertise and the right qualification to introduce us to what exactly such a systemic approach actually means. So handing over to you, Johan.
Okay, well, thank you, and thank you for the invite. I'm really happy to talk about this topic. We can talk about the billions of money we need for investment in sustainable development. The problem is if these investments are invested in the wrong way, they may not solve the problem. So it's not just a question of the size of money we need, which is important. So don't want to downplay that. But a very important aspect is how do we use that money? And my opening claim would be that a lot of the current investments, public and private investments, are in fact what we call system optimization. very simply said, what is system optimization is, for example, reduction of the use of pesticides instead of avoiding using it at all, which would be more a system change perspective, and would mean that we need to change the food system or the agricultural system. So when we talk about finance, we need to realize that finance is a system in itself that needs to change. So we don't just talk about how finance is changing others, let's say the energy system or the food system, the mobility system, but also how the finance system needs to change. And the current system is not fit for purpose. I think that's very clear. If you look at the rules, what we call rules that guide the current finance system, you know, the type of returns, the short-term perspective, the way the fiduciary duty is interpreted by a lot of institutional actors, the way impact is measured. So together with a group of public and private investors, we have been developing a new set of transformative investment principles, and they are published at the transformativeinvestment.net website. And these principles try to lay out new ways of thinking about financing. And I just want to highlight two aspects at this point. One is the portfolio idea, because a lot of private investment, also public investment, in fact, focuses, for example, on single companies. So should we invest in this company or not? Will this company enable system change? Well, first of all, it's very clear that transitions or system change will never come from one company. Even the big tech companies, I would argue, you need a whole set of companies and, in fact, interactions and instruments in order to enable transformation. So a funder or a fund should look at the entire portfolio, and not from a risk perspective, but also from a transition perspective. If you invest, for example, in 5 food companies, how do they strengthen each other, these companies? And if you want to add a food company to the portfolio, how does it fit into the existing portfolio in terms of its transformative potential? This question is hardly asked, neither, in fact, by the public investors nor by the private investors. But I think we should go one step further to what we call the transformative bundle in the Deep Transition Lab. The transformative bundle means that we need to coordinate across investors. So impact investors, for example, institutional investors and public investors, need to coordinate much better their investments. And at the moment, for example, we work with the government of Catalonia to think about a bioeconomy region, to transition to a bioeconomy region. And for that, you need a host of investments that need to be coordinated. And this coordination is missing. There's hardly also an intermediary actor doing that, and all the governance for this is also very unclear. So this would mean we need to change the finance system, build new actors, build new asset classes, new type of coordination. So that's my first intervention. My second is that we really need to think deep about system change, because I hear a lot people saying, okay, we need systemic change or system change, but it's often very unclear what people mean by that. What we in the Deep Transition Lab use is the idea that systems are driven by what we call rules. So I just talked about reduction of pesticide or avoid pesticides. That's what we call a rule. You could see it as a kind of routine or instruction for actors what to do, how to behave, which direction to go. So it also means that we see agents or actors in the financial industry, but also in business, as rule-driven. So we don't believe they are only driven by economic calculation or by political interest. They do what they are used to do. They are driven by routines and rules, and they are often implicit, and they are socialized across. So that there's and they are embedded in values and norms. So in the end, when we want to move to a new system, we need to change the underlying rules. And through that, sustainable behavior will become more automatic. So each system has a set of regime actors. So these actors are the ones that follow the dominant rules. So we have actors that follow currently the dominant rules in the finance system. And that comes with a certain interpretation of fiduciary duty, wealth creation, ignoring, for example, future shocks. Because, for example, we looked in the scenarios used by the Network for the Greening of the Finance Industry, and institutional investors are asked to align with this. And in these scenarios, there's hardly any attention to wars, which as an historian, really amazing. If you think about the world, and if you think about the coming 30 years, I think in your scenarios, you should include things like wars, and not as something that may happen, but something that will happen. It's the same with, I think, the climate risk. It will happen. It will have major impacts on markets, will lead to stranded assets. And in your fiduciary duty, you should take this into account. That is your fiduciary duty. So the point is that the regime, so we have regime actors, and the regime actors find it difficult to change. So what we need is a change of actor constellations. So we need new entries. We need actors who think differently, and we call them niche actors. And finally, systems have what you may call the instruments, or the kind of very visible components. These are industrial strategies, policies in place. For example, if you have a rule like reduce pesticides, this will be expressed in a specific policy. So in the policy, you will be able to read the underlying rule, but the policy also expresses this rule. It's the phenotype, you could say, while the rule is the genotype. And the point with systems is that we have technologies, we have industrial strategies, we have cultural symbols, perceptions, user preferences, and they are all aligned. So a system typically consists of a set of components that are aligned. So if you just change the policy and you don't change the technology and you don't change the cultural perception, system change is very difficult because you only change one element. You need to change the alignment with the other elements. And on top of that, in fact, you need to understand that you can change the policy, but if the underlying values and the rules are not aligned with the policy, implementation will become very, very difficult. People will start to game it, to avoid it. So you need an underlying change. And here I come to why the toolkit presented is useful, because it has the level of implicit change, which is about the instruments, the phenotype. And then there's a level of semi-explicit change, which is about extra constellation. It's about the power balances between actors, and we need to understand, we need to change the power balance. And then the deepest level is about mindset shifts, and this is about changing the rules. So I would say this toolkit does reflect the way I would understand system and covers the various dimensions. So in that sense, I would recommend you to have a close look. Thank you.
Thank you, Johan. Thank you so much for talking us through the kind of rationale for the approach that ZOE has taken, and also for whetting people's appetites a little bit, what to expect from our toolbox and the layers of change that it addresses. And now Lukas will show us the toolbox in more detail.
Yes, exactly. Thank you, Fran. And thank you also, Johan, for the very inspiring input. So as I mentioned in the beginning, what we did first when we started this project was talking to different stakeholders to understand the different barriers that are out there for mobilizing and redirecting private capital flows. We then came up with this iceberg model that you can see here, which is to integrate the barriers that we've identified into a systemic approach that conceptualizes the different barriers that we've identified on 3 levels. As Johan has already hinted at, that would be on the highest level, the explicit level of change. So this is about tangible investment barriers and refers to, for example, the economic viability of investments, but then also the question whether these investments can actually be implemented and if the real economy resources are available for that. Below that, we have the semi-explicit level of change, which refers to power dynamics, more precisely power imbalances. So whether there are power imbalances between relevant actors, especially between the decision makers, that are harming that are stopping the increase in green investment. On the deepest level, we then have the implicit change, which refers to the mental models or the mindset shifts. So this includes beliefs and assumptions and other worldviews of key actors that are relevant, for example, fundamental preferences and habits, and this can also then influence the level and the pace of the investments that can be mobilized. So then let's have a closer look at what these barriers are exactly. If we zoom in to the highest level of explicit investment barriers, we differentiate between the business case side and the implementation side. So on the business case side, it's first of all about the question, is there even a business case? Or what is the level of operational and capital expenditure? What is the level of demand that is available for the investment? And even if there's a business case in general, then there's still a question of what is the certainty of this business case. So is it really certain, or does it depend on a varying level of demand, for example, or of costs? And then in addition to that, we have the question of when is it actually profitable, the investment? So that would be the amortization structure. But even if we have investments that are sufficiently certain and have a good business case, there's still the other side, it's the implementation side, where it's about, is the business case even feasible to realize? And here potential barriers include a lack of the right human resources, or the lack of access to material inputs, or the right technology or adequate infrastructure to implement the investment. If we then go to the second level, which is the semi-explicit level in terms of power dynamics, we differentiate between formal power balances and informal power balances. Formal power balances refer to the representation and the voting rights within the explicit or the formal decision-making bodies. So when there's an imbalance here, that could then affect the investment decisions that are taken. But even if we don't have imbalances on a formal level, there can still be informal power balances. So that could include that the decision makers in the decision-making bodies might have imbalanced access to the information that are relevant, or the external influence, for example, by lobbyists on the decision makers could be imbalanced. And then if we look at the deepest level, the implicit level, we have the mental models, which we split up into fundamental preferences and habits. So fundamental preferences are more the deeply held beliefs that are really hard to change, which include things like the notion of value and purpose. It includes the time horizon with which decision makers take their decision. It could also include something like the question how risk averse decision makers might be. And then on the other side, we have habits, which are more the learned patterns of thinking and acting of the actors, for example, the decision making. So that could be, for example, the role perception that these actors have. So, for example, decision makers in companies, whether they perceive their role to be primarily about creating shareholder value, or whether they perceive this role to be also to create value added for society, for example, by protecting the environment. Then if we go to the next slide, we can see again the overview of the barriers on these 3 different levels and how we split them up. And then once we had identified and conceptualized the barriers in this way, we then identified policy tools that are available for policymakers to mobilize and redirect investments by overcoming these investment barriers. So here, step one was to identify the tools using desk research and literature research, but also looking into already existing databases and engaging with the stakeholders that I mentioned before. Step two was then to assign tools. The idea is here basically you will see that in a minute, that in the toolbox that we're launching today, you will have the option to filter the policies according to different variables. So that could be the policy area that this tool refers to. So something like, is it monetary policy? Is it trade policy? These sort of questions. But also in terms of whether it's already implemented or whether it's so far only an idea that might come out of academic research, for example. Or if we look at the fiscal effect, for example, we've also filtered whether we would expect these policy tools to, like, at least in the short term, rather cost some public money or potentially even generate public revenue, for example, if we're talking about taxation. The third step was then to tag the investment barriers. So this means assigning which tools can help overcoming which investment barriers, so that in the end, then our toolbox can really help users to understand which tools are available to overcome certain investment barriers. Then we can, if we go to the next slide, we have an exemplary overview of tools, because we probably don't have the time to go into detail on all the 130 policy tools that we have in our toolbox. So just to give you an overview what these tools could look like, you can see, for example, in the first row, there's a tool that is that refers to the traditional and more narrow focus on capital expenditure and how to reduce capital costs for investors. But then you can also see that the remaining rows include tools that are more targeted to other investment barriers that are then either on the business case side or the implementation side of the explicit level, or even deeper on the semi-explicit level around power balance or power imbalances, and on the implicit side on mental models. You can also see that the policy areas differ quite a lot, which is one of the main findings of this work, that mobilizing private capital is by no means only about financial regulation and only relevant for decision makers in financial regulation, but that addressing all the different investment barriers actually requires to look across many different policy areas, the policy areas that you can see here, but it also includes even other policy areas, like, for example, competition policy, trade policy, or taxation would be other policy areas that are also included in our toolbox, and that show how important it is to take a holistic approach and look at all the policy areas that can help with overcoming investment barriers. Then let's have a look at what this would exactly look like in the web application that we're launching today. So you can see again the iceberg model at the top as a reminder for what is the underlying idea behind this toolbox. But then most importantly, you can see on the left-hand side some filters where you can filter the policy tools. And most importantly, we have the filter on investment barriers. So here you would be able as a user to select the barriers that are most interesting to you, because if you are interested in a specific sector, for example, you might be more interested in the barrier of a lack of demand, for example, than the capital expenditure, and then you could filter by the specific barrier that you're interested in. And then on the right-hand side, you would see an overview of all the policy tools that are available to address the respective barrier. If you're then interested to learn more about one single policy tool, you could then click on the policy card, and that would open an overview of the policy tool, including a description of the policy tool, but also a potential example of where this policy might already be implemented, and an overview of what are the different barriers on the different levels that this tool can help with addressing these barriers. Then last but not least, let's look at the next steps that are coming. So we will definitely continue to update this toolbox, and are very happy to receive any input from you about that. So if you're checking out this toolbox and you have the impression that we're missing any policy tools, or that we should have assigned policy tools differently, and you think policy tools might help with different barriers, we're very interested to hear about that and to discuss that, and are very happy to continuously update our toolbox. Second, we do not only want this to be an overview of the policy tools that are available for addressing the different barriers, we would also like to help assessing which of the tools are most impactful and most feasible for overcoming barriers. However, this clearly requires a very context-specific approach. So as you can imagine, the question which barriers are most relevant, or which policy tools are most relevant for which barriers, and what is their potential, and which tools are most promising, really depends on the context, specifically on the sector or the application that we're talking about. So we will apply our toolbox to different cases, starting with industrial electrification and built environment as two applications that are very relevant for the green transition, trying to assess what are the most pressing barriers in these areas, and how can we, or which policy tools can we then use to overcome these barriers. And last but not least, this will also include a lot of engagement with the relevant stakeholders like policymakers and businesses, but also experts and from academia and think tanks. So whoever perhaps also in the audience might be interested to talk to us in more detail about this work, we are very happy to follow up on that, and yeah, very curious to hear what you think about this work. Yeah, and with that, thank you for your attention, and I'm handing back to you, Fran.